All right, hello, my fellow stock jobbers. Thanks for checking out our options basic class. This is for people that are just starting off. Options can be very complicated, but they can also be relatively simple. So we're going to just try to keep it on the simple side today. First question, why do traders love options? And the answer is you can make a hell of a lot of money from them. There are situations where stock might be up 10% or down 10%, but some of the options on it might be up by 500% or 1,000%. You can make a lot more money than you invest. So this is why traders like options. It can lead to big profits. They could also be used for other things too. You can use them to create income or to hedge yourself. You can use them to protect profits, which would potentially give you a tax advantage. And we'll explain that a little bit more. The best way to think about an option is it's a contract, and that's why they are called option contracts. It says so right in the name. Now, a call is something that you would consider buying if you think the market's going to go higher. And I'm going to say stock because that's kind of just my default, but it could be the case on whatever you're buying. It could be a crypto, it could be a bond. A call gives you the right to buy something at a specific price before the expiration date. For example, you could buy a call that gives you the right to buy a stock at $20 between now and a month from now. If the stock is at, say, 18, well, then your contract's not going to be worth anything, because why would someone buy the right to buy a stock at 20 if they can just go into the market at 18? If the stock is at 22, well, guess what? Then all of a sudden that option has value because you have the right to buy it at 20 and the stock is trading at 22. So that contract is going to be worth something. A put is the type of contract that an investor would buy if they believe the market's going to go down. A put gives you the right to sell a security at a specific price. So if you have the right to sell it at 20 and it's at 22, your put contract is not going to have any value, because why would someone buy the right to sell it at 20 if it's trading at 22 in the market? If the stock goes to 18, well, now you have the right to sell it at 20 and it's trading at 18. So your contract is going to have value. So puts are what you buy if you think the market's going to go down. Calls are what you buy if you think the market is going to go up. These these are the option contract characteristics. Okay. First is the asset, and like I said, I'm just going to refer to stocks, but you can do them on cryptos, various different things, ETFs. For stocks, the quantity is 100 shares, meaning each option contract you buy gives you the right to control 100 shares. The expiration date is, as it suggests, the date that the contract expires. The strike price is the price that the contract gives you the right to buy or sell from. So this stuff is all set in stone when the option is issued. The options are issued by option exchanges, like there's the stock exchange, but there's also option exchanges, because they get fees and so forth if people are trading their options. So that's where options come from. Now there's something called the premium, and this is set by the market. All right, this other stuff is set in stone. It's not going to change. The premium is going to change, and you also need to be aware of what we call open interest, volume, and liquidity. So we'll cover that in a few minutes. So this is the premium. Okay, this is the only characteristic that can fluctuate. Now, an option premium is what we call the intrinsic value plus the time value. This is how much your option costs, intrinsic value plus time value. Intrinsic value is how much your contract is actually worth. Okay. Now, like I said before, if you have the right to buy a stock at 20 and it's trading at 22, your intrinsic value is going to be 2. It will be 2 points or $200. If your stock is trading at 18 and you have the right to buy it at 20, well, no one cares because they could just go and buy it in the market at 18. So it would have no intrinsic value. A put is the opposite. If you have the right to sell something at 20 and it's trading at 22, well, you're not going to have any intrinsic value because no one's going to buy it from you because they could just go out in the market and sell it at 22. It's trading at 22. The right to sell it at 20 really isn't that big of a deal. Well, not that it's not a big deal, but it's it's worthless. Okay, say the stock is at 18, and you have the right to sell it at 20. Well, now all of a sudden, your contract's going to have intrinsic value. It's going to be 2 points. You have the right to sell it at 20, and it's trading at 18. So that's what we call intrinsic value. It's the difference between the strike price and the market price if the option is in the money. Time value. Now, because you're buying a contract, and again, that's the best way to think of these things, is contracts, because that's literally what they are. The farther out the expiration date, the higher what we call the time value is going to be. This is because the longer your contract lasts for, the greater the odds that something is going to move like you thought it would. For example, if you buy a contract that expires in a month for a $20 strike price, that's going to cost you whatever. If you buy an option with the same strike price, 20, but it goes out 6 months, well, that gives you an extra 5 months for it to go your way. So it's going to cost you more. So the farther out the expiration date, the more the time value is going to be. So the option premium is the intrinsic value plus the time value. Certain things can affect the premium as well. Higher volatility or popularity could increase it. And that shows up in the time value calculation. Now, for those of you just getting started out, there's really only one thing here I think you should really pay attention to, and that's the time value, right? Theta. They call this, if you listen to people talk about options, sometimes you'll hear them talk about what we call the Greeks. I don't know where this comes from, but these refer to the specific, what's the right word? I guess characteristics of a particular contract. So delta is the amount the option moves when the underlying moves $1. So say you have a call and the stock goes up $1 or down $1, whichever the amount that call option would move is the delta. But I don't think you really need to pay attention to that if you're just getting started off. Gamma is the degree that the delta changes. Vega measures the effect volatility can have on an options premium. So volatility, the more volatile it is, the greater the odds are that it'll go your way, so that's going to cost you a little bit more. But let's just focus on the theta, because some new traders can get burned by this. It's possible to be right about the direction of the market, but also to lose money, even if you bought the right contract. For example, it's possible for the market to go up, and you have a call option, and you could lose money, or the market could go down, and you have a put option, and you could lose money. This is because of time value, and it hurts a lot of beginners because they're not aware of it. Now, the time value is greater the farther out the expiration. As we get closer to the expiration, the time value is going to decrease. If something is out 6 months, there might be 5 points of time value on it. If something is expiring in a month, there might be 1 point of time value on it. So the longer the horizon, the greater the odds are that the security has time to reach or cross the strike price. And as we get closer, the time decay increases. The time decay will increasingly decrease. It's kind of hard to say, the premium. So think about this. You buy something that gives you the right to buy the stock at 20, and it goes out 6 months. So you have 6 months for the stock to go above 20, okay? And you pay, say the option is trading for 5. So you pay 5 for it, or $500. Now, let's just assume that if the option is out of the money, to the right to exercise that contract up to 6 months is going to cost you $5, or 5 points, I should say, $500. Now, just suppose you're right and the stock goes up and it goes to, say, 22, and we get to the expiration date. Well, you're going to have $2 of intrinsic value, so that's what your contract's going to be worth, but you paid $5, so you lost $3 or 3 points on the time value. So you were right, the stock went the way you thought it was going to, but because you had to pay that premium for the time value and the time value is greater than the current intrinsic value is, you're going to lose money. So this is a really important thing to understand. It's possible to be right and still lose money. Now, me personally, my background is in the institutional investment industry, but if I was trading options, my strategy would be and I'm just talking about me, right? There's no right or wrong way to do it. One of the things we talk about here is how you have to do stuff that fits your personality. So I would trade options I would buy and sell puts or calls if I thought the market was going to make an imminent move, meaning the next few days or weeks, the next few days or maybe a week or so. So I would want to buy an option with a shorter expiration date, because why bother paying for time value? If I think there's going to be a move in 3 days, well, I could buy an option that expires in 2 weeks because it's going to have a small amount of time value. If I bought the option with the same strike price that extends out 6 months, well, then I'm going to be paying a significant amount more. So for a short-term trader, you don't really have to worry much about time value and theta. In the short term, it's not going to really affect contract, but longer term it will. So that's important to remember. Part of the premium that you're paying when you want to buy an option is the time value. As you get closer to the time value, closer to the expiration date, the lower the time value will go. So if what you paid in the premium for the time value exceeds the intrinsic value, you're going to end up losing money even though you're right about the move. And as we get closer and closer and closer to the expiration date, the time value will move more rapidly. It accelerates. Or I should say the time value decay accelerates. All right, so that's the main reason why people trade options, is because they think the market's going to go up. So think about this, okay? The stock's at 20, it goes to 22. If you bought the stock, you'd be up 10%. That's great. The stock's at 20, and you buy the call options to buy it at 20, and say they cost you $300 or 3 points. Well, if the stock goes to 22, you have $200 on the $300 you spent. So that's a much bigger return. If it goes the other way, say it goes down to 18, yes, there are negatives in options too. I guess I should bring that up. If the stock goes to 18 and you own the stock, well, you would have lost 10%, but you would still have 90% of your value. If it goes to 18 and you have the right to buy it at 20, well, your option could expire worthless, meaning you lose all the money the $500 that you invested to buy it. So that's the main reason why people or traders like to buy options. There's also other things we can do. One is a protective put strategy, and this makes sense for a lot of people, and it's because of tax implications. Say you have a stock and you think it's going to go down, but you don't want to sell it because maybe you'll take a big gain, and you don't want to have it on your taxes or whatever. It's a tax thing. This is frequently used because of tax implications. So think about it. If you own a stock and you don't want to sell it, and the stock goes down, the value of the put will go up. So if you own a stock and you buy a put, it's a hedge. It's called a married put. The value of your stock goes down, but the value of your put goes up. So this is a pretty popular strategy, protective puts. You think your stock's going to go down, but for whatever reason you don't want to sell it, so you use a put to hedge. It's basically the cost of insurance is the price of the put, because your put is insurance against your stock going down. Another popular strategy is selling covered calls. This means you own the stock, but you sell a call. Now, typically, if you sell a call, it makes you think that you would think that the market's going to go down. Remember, you buy a call if the market's going to go up. You would sell your call if you think the market's going to go down. Now, if you own a stock and you don't think it's going to go higher, but you don't want to sell it, and I'm talking in the near term. Obviously, you wouldn't own the stock if you didn't think it was going to go up. But in the near term, if you think, all right, well, this thing is not really moving, well, you can go out and you could sell calls against your stock. And if the stock doesn't move, you get to keep the premium that you sold your calls for. It's called a covered call because if you sell a call, whoever buys it from you, you're guaranteeing that you'll sell the shares to them at a certain expiration price. If you own the shares, then you already have the shares that you can sell to them. So that's why we call it covered. So this is a strategy used by investors who are neutral or slightly bullish. All right, we're going to look at some option quotes in a few minutes here. And these are things we need to concentrate on. Now, if you're trading a really liquid stock or an option on a really liquid stock, like say Apple, you don't really need to worry about some of this. But if you're trading a stock or an option on a stock and it's not very popular, we have to think about these things. For example, what's the volume? If the volume and if the open interest is the amount of option contracts that are in existence. So the higher the open interest, the more positions there are. A stock like Apple is going to have a huge amount of open interest. A stock that you've never heard of, probably very small open interest. So the volume, if the volume and open interest are low, it could have a negative effect on your execution. Just think about it in the stock world, right? Say a stock is traded 1,000 shares and you want to sell 10,000 shares. Well, the last price might have been 20, but by the time you're done with selling your order, you knocked the stock all the way down to 15 because there wasn't enough demand or buyers to absorb it. And it's the same thing with options. So the bid price is the highest anyone is willing to pay, and the offer is the lowest that anyone is willing to sell. All securities that are traded, well, actually that's not true, but stocks and options all have bids and offers. So a stock might be quoted to 20 to 20 and an eighth. The bid is 20, meaning you could sell it right now at 20, and the offer is 20 and an eighth, which means if you wanted to buy it right now, you'd have to pay 20 and an eighth. The difference is what we call the spread. So if an option is illiquid, there's a chance that the last trade doesn't represent the current market. So you got to be careful of the liquidity. And let's take a look at something that will help you understand that a little bit more. Now this is U.S. Steel. Okay, at this time that this was taken here, the stock was trading in 1925, and let's just look at the $19 level. All right, so we're going to go over here and look at the quote. This is what we call an option chain. It's very different than stocks. It shows all the different various strike prices. Like these are the calls. This is the right to buy at 18, the right to buy at 1850, the right to buy at 19, the right to buy at 1950. So think about this. The stock is trading at this time at 1925. So the right to buy it at 19 is going to be worth something. You're in the money. Let's look over here. The right to buy it at 19 is quoted 117 to 121. So you're going to be paying, and I don't remember, I think this is about a week out. So the right to buy the stock at 19 is going to be worth at least 25 cents here, okay? Because the stock is trading at 19.25. If you wanted to buy this, you'd have to pay $121. That's where it says 121. If you wanted to sell it, you would get 117. So that's a pretty thin spread. But it makes sense, right? Because this option is in the money. The right to buy it at 18 is going to cost you more because the stock is a 1.25 in the money. So if you wanted to buy that right, it would cost you 185. If you wanted to sell it, it would cost you 178. Now this is the last trade. I hear it doesn't say it when this trade was, but this last trade might have been the day before, it might have been a week before, it might have been a couple hours before. Sometimes people see the last trade and they say, oh, gee, that's 188. That's a great price. I'm going to go ahead and sell. But if it's an illiquid option, the last trade might not have anything to do, or it might not really reflect the current market. So you need to look at the bid and the offer if you're trading an illiquid option. And we can tell this is illiquid because this is the open interest and this is the volume. There's literally nothing traded on that day. Now, if we look out here, the right to buy it at 21 when it's trading at 19.25 is not going to have any intrinsic value. So this is all time value. It would cost you 44 cents or $44. That's what you'd get if you sold, and you'd have to pay $46 if you bought. Right? So the right to buy it at 21 is not going to be worth much if it's at 19. Like, now let's think about this. Say it goes from 19 to 22. All right, and this is an example of where options can really make you a lot of money if you get to move the right way. Whatever the percentage there from 19 to 22 is, probably, I don't know, 11, 12, 13%, something like that. All right, it's a decent move. Okay, so the person who buys it at 19 and it goes to 22, or if you buy it at 19.25 and it goes to 22, you made a nice little profit. But look at the option now. Okay, so this is the call. This gives you the right to buy it at 21. If it goes to 22, this is going to have $1 of intrinsic value added to it. So what cost you 46 cents is now going to be worth at least $1, the intrinsic value. So you've more than doubled your money. The investor who bought the stock made whatever X percent, 12 or 13%. You have more than doubled your money. So this is an example of why people like options. Now let's just take a look at the puts. So, as expected, the right to sell a stock at 18 is not going to be worth much because it's trading in the market at a higher value. So people are going to be like, well, whatever. I'm not going to pay you for the right to sell it at 19 to sell it at 18 if it's trading at 19. So there's no intrinsic value here. This is all time value. Now let's just say you have the right to sell it at 21. You're going to have at least 2 points of intrinsic value. The strike price is 19. The contract gives you the right to sell it at 21. So you're going to have at least 2 points of intrinsic value. The 37 cents here is the time value, all right? Now look at how wide this spread is, 188 to 237. So you might see it trade at 237, or you might see the last trade at 241, and you think, oh, gee, that sounds like a great price. I want to sell my shares or sell my contract there. But you put in your order and you end up getting 188. It's like, what the hell? Well, that's the highest bid price at the time. So we need to be aware of bids and offers. Okay. Again, if your shares are very liquid, like if you're trading Apple, there's going to be a lot of liquidity. You're not going to have to worry about this. But a lot of newer traders get burned because they don't realize this issue with liquidity. All right, so let's just look at one more thing before I wrap it up here. Now, this is DuPont. These are very illiquid options, which I don't know why. I mean, this is a big company, but DuPont is trading at 77.47. So the right to buy it at 75 is going to be worth at least 2.74 in intrinsic value. And we're going out a week, so there's going to be some time value on that. So let's look at the 75 call. So $2 is the intrinsic value, or $2 and change. The rest of this is the time value. Notice how wide the spread is here. I mean, this is incredible, 465 to 175. That's a huge spread. And it's because it's a very illiquid option. It's only got 34 open contracts, and only 15 have traded on the day. So remember, if you're trading something that's illiquid, you should understand what the bid is and what the offer is. The last trade might not have anything to do with the current value. Now, let's do the opposite down here with puts, right? The right to sell it at 75 is, big deal. You can go into the market and sell it higher. So all this is going to be your time value. But if it's trading at 77.47 and you have the right to sell it at 77, well, that gives you a little bit more, it gives it a little bit more that the odds might go in your favor. All right, so let me just wrap it up here. So just remember, calls and option, or calls and puts are contracts. Just summary. So option strategies can be pretty simple. They can be extremely complex, but we're just concentrating on simple things. A call is an option that, or a contract that gives you the right to buy a stock at a certain price. If you think the market's going to go up, you would be a call buyer. Because you think, say, the stock's at 20 and it's going to go to 30, well, you would, hey, I'm going to buy the 20 calls. And if the stock does go to 30, well, if you were own the shares, you'd be up 50%. But if you own the options, you bought the 20 calls for $2. Well, now on your $2 investment, you made a return of at least 10. You've made 5 times your money. And the opposite is true on the put side. If you think a market's going to go down, you sell the puts, and if the stock gets below where you have the contract or the right to sell it, your contract is going to be worth something. If you have the right to buy something below where it's trading, that's going to have value. If you have the right to sell something below where it's trading, it's not going to have value. If you have the right to buy something, actually, am I saying that wrong? All right. If you have the right to sell something at a higher price than where it's trading, your contract is going to have value because whoever you bought that contract from guarantees that they will buy the shares from you at that price. So if the stock's trading at 15 and you have the 20 puts, you can go and sell them to this person at 20. And the stock's at 15, so your contract is going to have value. The calls are the opposite. If the stock is trading above your expiration price, it's going to have value. Think about it, it's a contract, right? Hey, I have the right to buy this thing at 20 on my contract here, and it's trading at 25. My contract is going to be worth at least $5. All right, so that's it, everybody. I don't want to get people confused, but if you have any questions, feel free to reach out, and I will talk to you soon. Thank you, stock market jobbers.